Hitesh, hi, thank you very much for taking the time out. So that is exactly our question that, are there going to be some companies which might just go belly up within the internet space come 2017 simply because of the increasing losses that we're seeing?
You're right. You see, losses went up substantially at internet companies over the last 2 years, right? But this is also because funding was freely available. But I think what has happened over the last 6 to 9 months is that most companies have seen the writing on the wall. They've understood that they need a path to profitability if they have to survive in the long run. And I can tell you that many of them are actually working on cutting their losses.
How are they cutting losses, Hitesh? How exactly are they becoming asset light at this point in time? And when exactly would they even break even on, on the bottom line, according to you?
You see, what was happening was that because there was hyper competition, companies were spending a lot of the money they had raised on, if they were e-commerce companies, they were giving massive discounts. Otherwise, a lot of the money was being spent on marketing and advertising, right? So what has happened over time is because now there is pressure to sort of shore up the top line and improve the bottom line, companies are getting smarter about discounting. Companies are getting smarter about advertising and marketing. They've cut spend, they've cut the burn. They're not hiring as many people as they were hiring earlier. They're not paying salaries that are as crazy as what they were earlier. So in general, what I can tell you is that most of these companies, of course, they're very far away from becoming profitable. They're yet to get to break even. It'll take them a while. But they are working on cutting the burn, and they're working on growing their top line.
All right, let's introduce one more voice into this conversation. And he's a man who'd know a thing or two about running internet operations or digital company operations. Vijay, Shekhar, Sharma, founder and CEO of Paytm, is with us. Vijay, good afternoon. Thanks for joining in on the show. So it's a note by Kotak. I mean, it's kind of raising the obvious questions which are on people's minds that while sales are growing, the question is the rate of burn, the rate of losses is increasing. Is that going to change in 2017? And we talked to you at a time where there's this growing debate of capital dumping. I mean, there seems to be a tirade against companies that have backing of international big money bags.
Well, I treat technology as an infrastructure investment. When you are changing a habit, you're nearly building a new road. And companies which go ahead and build that kind of moat in their business, they take time to build a sustainable, profitable business. I don't think anybody who was dreaming for 5 years of not break even, and I mean, like they were expecting break even before 5 years, were supposed to be even in the game. Or they were probably in the game so that they can flip into some other company. I believe that companies will continue, those who are winning the market will become far more aggressive and spend even more in 2017. And those who do not have what it takes to fight the large money, they will continue to cut back the losses and start to float or find a buyer for them.
Hitesh, I want to ask you about what you're doing beyond your three portal, 99 Acres, Naukri and Jeevansathi, because at your end, InfoEdge has been making increasing investments in a lot of startups. I mean, there is Dero Labs, there's VCare, there's MyDala. I believe you have an investment in Policy Bazaar and, of course, Zomato. Is that policy going to change these niche investments that you've been making, given the fact that there is a struggle at the operational level?
No, see, if you look at what's happening to InfoEdge, we have, like you said, these few, the businesses we run inside the company. Now, most of them are either breaking even or making money now, right? So it's been a long road, of course, for 99 Acres and for Jeevansathi. Jeevansathi broke even last quarter. 99 Acres is flirting with break even. It's getting there almost. So as far as our internal businesses go, they're mostly profitable or getting there. We've also been investing outside, like you said, for the last few years. We made about 13 or 14 investments. And there are, like in any portfolio, there are some companies that are doing well and some which are not doing so well. You mentioned Zomato early on. Zomato was, there was a point in time when Zomato was burning $7-8 million a month. But now the burn at Zomato is down to $1 million a month. And they've also managed to double the top line at the same time. So I guess a lot will depend on how people run their businesses and what is their philosophy.
Okay.
Yeah, there are some sectors which require a lot more investment, like Vijay said, because you're building for the long term. But there are enough other internet businesses where if you do a good job of running your business,
will Zomato break even?
Your top line, but also make money.
Okay, Vijay, we just have time for one quick last question, so we're going to pose this to you. What will your financials look like in 2017, especially post demonetization, because you're one of the biggest beneficiaries of that to take place in the digital world? And would you have enough funds to maybe buy out a couple of your smaller, players?
Yeah, so two things. 2016, I remember we spent 2,600 crores, reaching 2,600 crores there, and we had losses about 1,500 some extra crores. And if you look at 2017, both numbers will be higher because we are spending a lot more money than this we spent last year as we speak. Remember, demonetization has not given us extra revenue because we are growing the market and spending money in the market. So we will have extra losses to take care of it, not extra revenues to earn, if you notice that. And now talking about the money to buy a smaller player, I don't think that we have interest to buy any smaller player at all, absolutely there, because I believe that that kind of market share that we are sitting at it and the kind of market lead and the kind of business that we are in, we don't need a competition to be acquired. And I'm personally a person who would believe that building is better than acquiring. So we've always remained as a builder of the sector, builder of a technology, builder of a business, never grown up out of acquiring. So we will remain averse to acquiring companies even in 2017.
Hitesh, I have exactly 5 seconds. My director is telling me to wrap. Will Zomato make money in 2017?
Well, if they want to, they can, but they may want to become more aggressive and enter new markets and launch new services. But if they want to, I'm sure they can.
All right, Hitesh and Vijay, thanks so much for joining us on